Okay, this is the introduction to the Full Throttle Options Mastery course. So welcome, I'm Carl. I will be your instructor on this journey, and I've been trading for over 30 years, and I figured out how to make a living trading options. And I've gone through over 30 online trading courses on YouTube, which led me to the conclusion that the only trading instructors who are legitimate are the ones that actually share their P&L. Throughout my years of experience in options trading, I've helped countless individuals navigate this fascinating world. In this course, we'll demystify options trading and equip you with the knowledge and skills to make informed trading decisions. So by the end of this course, you'll understand the fundamental concepts of options trading. You'll know how to analyze and interpret options data. You'll be able to develop and implement basic options trading strategies. You'll have the confidence to start trading options. And this course focuses on both practical application and real-world examples to ensure your success. Now here's a roadmap of what we're going to cover. So I'm going to go over these sections here. First, the introduction, which kind of gives you the basics. And then I'm going to get into a little more detailed stuff with basic option strategies themselves. We'll talk about risk graphs and defined risk strategies and things like that. Then I'll get into option pricing basics. You need to know some things like intrinsic, extrinsic value, time value, things like that. And then finally, I will get into the Greeks, the first order Greeks, because those are always important to know. Now, a quick disclaimer. I'm not acting as a licensed financial advisor. The following videos are for education and entertainment. My wife told me that this stuff's boring, so it's mainly educational. And investing of any kind does involve risk. And while it's possible to minimize your risk, your investments are solely your responsibility, and it's very important that you conduct your own research. And I'm merely sharing my opinion, and there's no guarantees of investment gains. Now, moving forward, you're about to embark on an exciting journey into the world of options trading. With the knowledge and skills you'll gain in this course, you'll be well on your way to making informed trading decisions. Remember, success in options trading requires discipline, patience, and continued learning. And my team and I are happy to support you every step of the way. So we'll see you in the next lesson. The building blocks of options. Here's what we'll cover. We'll discuss the definition of an option and their key components. We'll compare the difference between stocks and options. We'll overview buying options through a house buying analogy. We'll overview selling options through an insurance analogy. We'll discuss a few other key terms for understanding options. Now, the foundational definition: an option is a contract sold by one party to another for a price. And that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at an agreed upon price within a certain period of time. So why do they even exist? Options have a rich history that dates back several centuries, and they exist for a few key reasons. Risk management is one. Options were initially created to provide farmers and merchants a way to hedge against the risk of price fluctuations in agricultural produce and other commodities. By locking in prices for future transactions, they could manage the risk of unpredictable market changes. Also, they're used for speculation. Over time, options became popular financial instruments for speculators. They allowed traders to bet on the future price movements of assets without needing to own the underlying asset. This offers a way to potentially profit from the market movements with a limited investment, or the cost of the option. Also, third, leverage. Options provide leverage, meaning traders can control a large amount of the underlying asset with a relatively small investment, the option premium. And this can amplify profits, but it also increases the risk of losses. And fourth, flexibility and diversification. Options offer various strategies for investors to make profits, hedge portfolios, or generate income. They add flexibility to the investor's toolkit, allowing for strategies that are not possible if you were just buying or selling stocks. Now here's a super brief history of options. In ancient times, The concept of options can be traced back to ancient Greece, where a philosopher is credited with using options on olive presses to make a profit. In the 17th century, options appeared in the world of finance in Holland. They were associated with the tulip mania. Now, the modern options market was developed in the 20th century, especially after the establishment of the Chicago Board of Options, the CBOE, in 1973. And that standardized options and brought them into the mainstream financial world. I'm going to break down the definition to foreshadow future concepts and terms. So an option is a contract. Now there's two types of contracts. Sold by one party to another, so that means it needs to be a buyer and a seller, for a price, which with options you would refer to that as premium, that gives the buyer the right, but not the obligation, to buy or sell. That would be using a call or a put, an underlying asset, which could be stocks, bonds, etc., at an agreed upon price. Agreed upon price is like this strike price, with a certain time period, which is, when you talk about a certain time period, you're talking about an expiration date. So right now I want to list out the standard terminology of options so you have an idea, and I will discuss each of these items in more detail later. So standard terminology: a call. This contract gives the buyer the right, but not the obligation, to buy the underlying asset at the strike price before the expiration date. It's typically bought when you expect the asset's price to rise. A put option. This contract gives the buyer the right, again, but not the obligation, to sell the underlying asset at the strike price before the expiration date. It's usually bought when you expect the asset's price to fall. Underlying asset. This is the asset on which the option contract is based. It can be stocks, bonds, commodities, currencies, indices, futures, or even other financial instruments. The strike price. This is the predetermined price at which the underlying asset can be bought or sold under the terms of the option contract. The contract size. This is the amount of the underlying asset covered by the option contract. In stock options, for example, one contract typically represents 100 shares of the underlying asset, which is the option contract multiplier, which is 100. Expiration date. This is the date which the option contract expires, and after this date, the option can no longer be exercised or traded, and it becomes worthless. The premium. Now, this is the price paid by the buyer to the seller to acquire the rights granted by the option. The premium is influenced by various factors, including the underlying asset's price, the strike price you're dealing with, the time until expiration in that contract, and the market volatility. And we have assignment and exercise. So when the buyer of an option exercises their right, the seller is assigned the obligation to fulfill the other side of the contract. Now I'm going to list out the key differences between stocks and options. Ownership versus right. So stocks. Buying a stock means you own a piece of the company. You have shareholder rights, including voting rights and dividends if the company offers dividends. Now with options, buying an option does not give you the ownership of the company. Instead, it gives you the right to buy or sell a stock at a predetermined price before a certain date. The investment cost. With stocks, typically you pay the full price of the stock up front. With options, you pay a smaller amount, the premium, for the potential to buy or sell a stock at a specific price. This makes options a leveraged instrument. Now, risk and return. With stocks, the risk is limited to the amount you invest. The potential for gain or loss is tied directly to the stock's price movement. With options, the risk can vary. For buyers, it's limited to the premium paid, but the potential return can be significant. For sellers, the risk can be much higher. The expiration date. With stocks, they don't expire. You can hold on to them for as long as the company exists. With options have an expiration date. you must exercise them before this date or they become worthless. The profit mechanism. With stocks, profit comes from the stock increasing in value if you're long and or dividends. With options, profit comes from the movement of the stock in relation to the strike price of the option. Complexity. Stocks are relatively straightforward. You buy low, you sell high, or you sell high and you buy low if you go short. With options, they're more complex due to various factors like the strike price, expiration date, volatility, and even more factors than that, etc. The purpose. Stocks are generally for long-term investments and ownership in a company. Options can be used for various strategies, speculation, income, or hedging risk in a stock portfolio. Here's a key concept to remember. Options are a depreciating asset. Options have an expiration date. All else held equal, as the expiration date approaches, the value of the option diminishes, reducing its overall value. The word depreciating can be used interchangeably as decaying assets or wasting assets. With stocks, on the other hand, there is no expiration date. They represent a share of ownership in a company and can theoretically exist indefinitely as long as the company remains in business. Helpful option analogies. Two metaphors to describe options. Number one, buying an option. I'll use the house analogy. And when I'm talking about selling an option, I'll use the insurance analogy. Analogy number one, buying an option, the house analogy. Imagine you're interested in buying a house that's currently worth $100,000. You believe the house's value will increase, but you're not ready to buy it yet. So you make a deal with the owner. You pay them $5,000 for the option to buy the house, $100,000, within the next year, regardless of its market value at that time. So here's kind of the deal with the house owner. You pay them $5,000 for the option to buy the house. You can buy it at $100,000. And you must be willing to buy the house within the next year, regardless of the market value at that time. So the $5,000 is considered the premium. The premium is the fee paid by the buyer for the possibility of conducting a future transaction on the house at an agreed upon price. The seller receives and gets and keeps the buyer's premium as compensation for providing the buyer with this opportunity, regardless of the outcome. The strike price is the fixed price at which the seller is obligated to sell the house to the buyer if the buyer chooses to exercise his right to buy the house. So he doesn't have to buy the house, but he has that right. The expiration date. The expiration date is the last date on which the option can be exercised by the buyer. Beyond this date, the contract becomes invalid and the buyer loses his right to buy the house at the predetermined strike price, in this case $100,000. So here's the value of the contract over time. So here's the buyer's perspective. The value of the call option increases as the house market value rises above that strike price of $100,000. The buyer sees a positive return because they have the right to buy the house at $100,000 even if its market value is higher than $100,000. The difference between the market value, $100,000, the difference between the market value and the strike price, minus the premium paid, represents potential profit. The seller's perspective. For the seller, as the house's value increases beyond $100,000, the potential cost of the transaction rises. While they receive their premium, the $5,000, they now face the possibility of selling a house for less than its current market value if the buyer exercises the option. So the seller's house, they can't sell it to anybody else for a full year. So the house is tied up for that 1 year period. The premium compensates for the risk, but the net outcome depends on the difference between the house's market value and the strike price at the time of when the buyer decides to exercise the option. Analogy 2, selling an option. So this is the insurance analogy. So when you sell an option, such as a put option, you're essentially taking on the role of an insurer. Just like an insurance company receives premiums for agreeing to cover potential future damages, as an option seller, you receive a premium for taking on the risk of the underlying asset's price movement in the future. If the asset's price moves unfavorably, similar to an insured event occurring, you may have to pay out just as an insurer would. In both cases, you profit by collecting premium as long as the anticipated risk event, the asset price dropping or the insured event, does not occur. So here's a more in-depth difference between option buyers versus sellers. So here's option buyers. The buyer of an option acquires the right but not the obligation to buy in the case of a call option, or sell in the case of a put option, an underlying asset at a specific price, the strike price, on or before a specific date, the expiration date. The risk for the buyer is limited to the premium paid for the option. This is the maximum amount that they can lose. The profit potential for a buyer is theoretically unlimited in the case of a call option, as the price of the underlying asset can rise indefinitely. In the case of a put option, as the price of the underlying asset can fall significantly, but not below zero. Now, option seller, the seller or writer, sometimes called a writer, of an option takes on the obligation to sell in the case of the call option, or buy in the case of a put option, the underlying asset if the buyer decides to exercise the option. The risk for the seller is potentially unlimited in the case of a call option, since there's no cap on how high the underlying asset price can rise. And the risk is substantial in the case of a put option, up to the point where the asset price falls to zero. The profit potential for the seller is limited to the premium received for selling the option. It's like what an insurance company would receive for selling a policy. Important option terms: moneyness. We're going to talk about moneyness. So the simplified definition of moneyness. Moneyness in options refers to the position of the underlying asset's current price relative to the option's strike price. So we've got some key definitions here. ITM, in the money, and OTM, out of the money. So in the money, this term is used when the option has intrinsic value, and I'll cover that later. For a call option, the right to buy, it's in the money if the current market price of the stock is above the strike price. For a put option, the right to sell, it's in the money if the market price is below the strike price. For instance, if you have a call option with a strike price of $45 and the stock is currently $50, the option is in the money by $5. It's kind of like having a lottery ticket that's already a winner. Out of the money, this is when the options have no intrinsic value, and we'll cover that later. For a call option, it's out of the money if the market price of the stock is below the strike price. For a put option, it's out of the money if the market price is above the strike price. For example, if you have a call option with a strike price at $55 and the stock is trading at $50, the option is out of the money, and it's out of the money by $5. It's kind of like having a lottery ticket that has not won yet. Now, this is called money here. So you have a call option, and the strike price, if it's below the underlying asset's price, then it's in the money. And with a call option, if the strike price is above the underlying asset price, it's out of the money. With a put option, it's the opposite. If the strike price is below the underlying asset price, it's out of the money. And if the put option strike price is above the underlying price, it's in the money. And now you also have one more thing here in the option. If the strike price is relatively close to the underlying asset price, it's at the money, ATM. So a quick recap. We discussed the definition of an option and their key components. We compared stocks versus options. We overviewed buying options through the house analogy. We overviewed selling options through the insurance analogy. We discussed in the money versus out of the money and also at the money. And next, we'll discuss some basic practical use cases for utilizing options. See you in the next lesson. My new book, it's out, called All Market Trading Profits. And for those who don't know me, my name is Carl Dahm, and I'm also known as the Transparent Trader. My marketing guy, he convinced me to write a book that shares my secret trade details with you. It's the same trade I used to make $597,210 in third-party verified profits from 2019 to 2023. I'm not sure how long I'll keep these secrets in my book, so you might want to grab a copy before I change my mind. Don't miss out. In my book, I reveal the unique trade structure I developed, something you won't find anywhere else. The book isn't AI-generated content. It's real organic material. If you're interested in learning the trade that drives over 70% of my net worth, click the link in the description to get the book and see how I achieved my results. The book is $30 on Amazon right now, and I'm offering a downloadable version for only $5. See that link in the description.